Welcome to the very first Aire Advisors podcast. We are closing out 2023, and given that, we thought it would be a great idea to discuss charitable planning. So we're very pleased to have Kyle Casserino. He's Vice President and Charitable Planning Consultant at Fidelity Investments with us here today. Thank you very much, Kyle, for coming. Let's just start broadly with what does the landscape of philanthropy look like in America today?
So Amir, thanks for having me. I guess I'll start by saying last year, so 2022, Americans gave about $500 billion to charity. So that's about 3% of the US GDP. You think of that a lot. It's like, all right, it must be on the backs of huge companies or big foundations, but really almost 70% of that giving is done by individuals across the country. So the US by far, in terms of developed countries, has some of the best tax benefits for giving, which is really incentivizing for a lot of folks to do so.
Yeah. Wow. And so let's talk about donor advised funds. What is a donor advised fund? And why are they all of a sudden so popular? There's evidently 2 million households in America using a donor advised fund, with over 1,000 of them in the industry. So what are they and why are they so popular now?
Yeah, so they've gotten really popular over probably the last 7-8 years, and we'll talk about why. But really, donor advised funds, what they are is, it's an account, it's a charitable giving wallet essentially that helps donors, whether those are individuals or companies, entities, separate the timing of their tax benefits when they actually have to give the money out to charity. So when they put funds into the account, whether that's cash or appreciated assets, the donor takes the tax benefits right then and there. The assets inside the account have the potential to grow tax-free. And then the donor really uses it like a charitable wallet, sends funds out to their favorite nonprofits, really at their own pace in their own time. Why they're so popular? Well, 2016, 2017 Tax Cuts and Job Act, that really buoyed the landscape of donor advised funds. And I've been here now 11 years, and I've seen us go from what really felt like a startup at Fidelity. We had about 70 employees, about 50,000 donors, and now fast forward to today, and we're over 700 employees and well over 400,000 donors. And the reason for that is 2016, 2017 Tax Cuts and Job Act, it doubled the standard deduction, took away a lot of popular itemized deductions too. So really, folks that were giving away a few $1,000s a year to charity really didn't have any tax benefits for their giving anymore, right? You're taking the standard deduction or you're itemizing. With the itemized deductions, there's really 3 major ones left. So that's state and local taxes. That's really your property tax, but that's capped at $10,000 a year. Mortgage interest and charitable giving. So you think about somebody that's probably older in age, maximizes the $10,000 a year in property tax, and doesn't have a mortgage. Those folks have to give away like $16,000 a year just to take the same tax deductions if they didn't give away a penny, right? It's that $26,000 standard deduction threshold. So what ends up happening is that folks have realized, well, hey, I can front load my donor advised fund, so I can put several years worth of giving, so I actually have the tax benefits of giving to charity still, even if they're not giving out that full amount, but they'll give it the same amount to their favorite charities over their own pace and their own time. So that's really buoyed the number of accounts. And over that same trajectory, we've seen actually the account sizes, the averages drop, right? So of course, now that folks are giving and using the donor advised fund to basically bunch their giving, right, put a few years worth of it, our average account size now is a little under $200,000. Our median, though, is only $19,000. So common misconception is that folks are like, well, hey, I have to be giving away hundreds of thousands of dollars a year to charity to take advantage of these donor advised funds. But really, you can be giving away a small amount to charity every year and still take advantage. So yeah, our median $19,000, 60% of our accounts are under $25,000 because of really this reason. And like you mentioned before, now there's over about 2 million households in America, over 1,000 different donor advised fund providers. So the growth in this space is astronomical.
Yeah. And so what type of assets can be contributed to a donor advised fund? And if you talk about the benefits of contributing appreciated assets versus cash.
Right. So yeah, I mean, I think it's so easy to give cash to charity, right? I mean, it's like a lot of charities make it easy on their websites, right? You can use your credit card, do PayPal, whatever the case may be. And it really is easy to give cash to charity, but cash is the most inefficient asset you could possibly give to charity, because think about what you have to do to actually give cash, right? You either have to earn it as income, pay income tax on it, or you have to sell an appreciated asset and pay capital gains. That's what it costs to give cash to charity. So a lot of folks will use appreciated assets because really the IRS incentivizes folks to do it. So there's a double tax benefit. And keep in mind, This is specific to long-term appreciate assets, so assets held for a year or more.
Yeah.
So clients that are interested in gifting assets like this, they not only get the fair market value deduction, so just average the high and the low of the shares when they contributed, they also don't have to pay the capital gains tax on the growth.
Right.
So hugely incentivizing, right? So somebody that's, I mean, it really is the example, right? You bought Apple stock 5 years ago for 20,000. Now it's worth 50. It cost that donor $20,000 to give away 50,000, and now they're having to pay the capital gains tax on the $30,000 of growth.
Right.
The alternative is you have to sell that asset and pay the capital gains tax on the 30,000. So now it's less money to charity, less for a deduction. But a lot of people come to me and are always like, well, Kyle, you know, that Apple stock is doing so well. I don't want to get it out of my portfolio. That same person was going to give away $50,000 in cash. Just give away the stock and then buy the shares back in your investment account.
Yeah.
Right. That way you get the step up in basis so that when, you know, fast forward 2 or 3 years and you're like, I do want to sell this. Now you're paying capital gains on today's value, that future value, not 5 years ago when you bought it.
That's great. And can you actually also, while we're talking about this, talk about the qualified charitable distribution
Yes.
from an IRA and compare that to donating appreciated stock?
Right. So this is a scenario where actually cash is probably good to give, right?
Yeah.
So qualified charitable distribution, what it allows is now the RMD age, let's take a step back, because the RMD age is now 73,
Right.
but the qualified charitable distribution actually starts when you're 70 and a half still.
Mhm.
So what it allows folks to do is give $100,000 up per year, tax-free, from their IRA account to their favorite charity. What's cool about it is that it counts towards the RMD,
Right.
and they don't have to pay income tax on the withdrawal.
Yeah.
Right. So for folks that don't need the money from their IRA account or have, you know, income in other places, this is a great way to fund charities. Right. Because
Right.
it'll really, you know, that double benefit. Right. No income tax on the withdrawal. You don't take the income hit on it, and you can benefit your favorite organization. So it's super helpful for folks. And then this year, starting this year, there's also a one-time $50,000 option where you can give it to a charitable gift annuity or a charitable remainder trust for that same benefit, which allow the donor to get an income stream from the gift to a charity.
Right. So talk to us about the concept of pre-funding giving in retirement by using a donor advised fund.
Yeah. So we've been around 32 years now, so we've seen really the trends and who uses these accounts and who benefits really play out. So our average donor, when they open these accounts, is typically in their 50s, although that number is going down year by year. But our average donor age is about 62. So you can kind of see that this is almost like the 401k version for charitable giving, where folks will say, okay, my last few high income earning years when I'm actually working, I'll fund my donor advised fund without even the intention of giving it all out right away, because of the idea that they're in a higher income tax bracket. They can benefit from the bigger deduction, but sometimes more importantly, this is a planning tool for clients where they don't actually have to dip in their own pocket to give to charity when they're retired.
Right.
They already have this money set aside. Keep in mind, it's also growing tax free. So for folks that can benefit from taking a big deduction in their last few high income earning years, it's a great opportunity for somebody to say, well, hey, I can pre-fund my giving in retirement so that it's just another planning option, just like a 401k or a 529 plan.
So what is the typical profile of somebody? You know, you mentioned that the average is 62, but
Yeah.
What is the typical profile of someone? What would make sense for them to consider a donor advised fund?
I really look at profiles, and it's mostly the 3 different buckets of folks. So the first of which is what we call something like a give grantor, who uses the donor advised fund strictly as an administrative tool. This is a client that's sending out, let's say, 10, 15 gifts a year to charity. They're doing it with their credit card. They're writing checks. They're saying, oh, send 5 shares of Apple here, 10 shares there. At April or October of the following year, it becomes sort of an administrative hassle, right? Where you're like, okay, I need to look at my check register, credit card statements. Did I get that tax form from that charity? It becomes sort of cumbersome. And a lot of times people leave money on the table because they forget about the couple $100 they gave to their nephew's Relay for Life, right? So what they do is they'll pre-fund their donor advised fund. They'll say, hey, I give away $20,000 a year to charity. I'll put $20,000 into the account in January or December, whenever the cadence is, so that at tax time, there's one tax form to give to their CPA, and that's from the donor advised fund. And then they'll just zero out their account. They'll just distribute all the funds to their favorite charities, do so at their own pace and time, and just replenish the next year. That's sort of profile 1. Profile 2 is sort of that bunching concept where they're saying, well, hey, I need to, in order to itemize my deductions, I'll put maybe 2 to 5 years worth of giving, itemize that year, take the standard deductions in future years, all the while give to their favorite charities at their same pace they always have.
Right.
And then the third, which is sometimes the biggest, is these folks that are looking at it like having a huge life event, right? Where it's all of a sudden a higher than normal income year, exercising stock options, selling real estate, selling a private business. Those are all events that create a huge income spike. So those are times where folks will pre-fund their giving, not only for their own, the rest of their lifetime, but even sometimes the next generations, right? Where they have a significant event and they're saying, well, hey, this is a great time to make a big gift because we can really use the deduction.
So how do donor advised funds fit into a family's legacy planning? How can clients get their families involved in philanthropy across generations?
So it becomes sort of it's sometimes a sensitive topic to talk about with folks. And we see it play out a lot where mom and dad like to give to certain charities. They give to their religious house of worship, their alma maters, but then the kids have totally different ambitions with charitable giving. So in the donor advised fund structure, there's actually a sort of an e-gift card option where folks can send those funds to a recipient for them to then spend at their favorite charity. Right. So a lot of folks will use it. The parents will use it with their children, nieces, and nephews to say, okay, let's give them some ownership, right? Let's start getting them involved and start getting them to think about charitable giving. The worst thing is when the successors, right, the next generation of our donor advised fund account holders, their parents pass away. All of a sudden now they have $1 million of charitable assets that they have to give away. They've never given to charity before. Right. So you want folks to start thinking about that. And this is also, I mean, when you think about legacy planning, it's an easy conversation to have with folks. I mean, we do it a lot in the trust and estate aspect, but people don't really think about charitable giving, right? Where sometimes the first generation, next generation really wants certain charities or initiatives to benefit. So it's a really important conversation to have with the next generation to say, hey, we really have our ambitions, but you should also take care of yours too. So this is sort of a lighter way to engage the next generation in something that's, a really important topic for folks. And it's important to get that on, not really, I mean, even on paper, but just out there in the open.
And, we work with a lot of business owner clients. And maybe we could talk about how donor advised funds can be used when selling a business.
So Amir, so what's interesting is we talked a little about appreciated stock before, and that's easy, right? I mean, you look at your investment account, you see the percentage growth. Okay, that Apple stock's up 300%. I'll gift it. What's often overlooked are these non-publicly traded assets to fund philanthropy. So we think about non-publicly traded assets like private business interest, real estate, equity compensation awards with publicly traded companies. So these are all types of opportunities where, well, all of a sudden now you look at your portfolio, when you give to charity, you want to give the asset with the highest percentage growth, right? Because that's the one that you have to pay the most in capital gains on. So these, just like we were talking about before, when you're selling a company, all of a sudden that income is really high that year, right? So folks don't realize, oh, okay, well, I can actually give those assets pre-tax to fund my philanthropy. So not only do they not have to pay the capital gains on it, they get the deduction in the high income year, but then they strip that equity out of their taxable interest.
Right.
So when you think about it for a client, I mean, it's a no-brainer. A lot of times these assets have a zero basis or very close to nothing. So they're basically, the donor is paying capital gains tax on almost their sale price of the company. What's really easy to have the conversation with is, okay, well, giving that asset pre-tax helps them do all the benefits. But sometimes, let's say you're selling your company for 50 million. A lot of times we get the calls from the accountants and say, well, hey, client sold the company for 50 million this year. We did the math. They should give away maybe 5 million after tax to offset some income. Right. Well, that's great, but you get a $5 million deduction if you give away cash or if you give away appreciated assets. The key difference now, though, is if you do it pre-tax with the business, you're not paying the capital gains tax on that 5 million. You're getting a $5 million deduction, but you're getting a $5 million deduction on 45 million now. Right. Not the 50. And you're giving the asset with the highest percentage growth. So it's a huge win for folks.
That's great. So we've talked about the private assets. We've talked about appreciated assets, talked about qualified charitable distributions from IRAs. Let's put kind of those and other things together. How do you create an effective giving plan? And what are some of the things we may need to know about year-end planning?
So the giving plan is really interesting because over the years, people have been more thoughtful about who they give to. I mean, we see it every day with giving to charity, right? Where you're saying, hey, if I give $1 to this organization, how much is used for the administrative versus the program of it, right? So like people will do their diligence and realize, oh, okay, well, hey, these are some charities that we want to give to. We also have a lot of donors that do giving with their religious house of worship and set it up on a monthly basis or have their tithing requirements. So the giving plan it's hard to create a structure around it and say that this is a template for everybody because everybody's so different, right? I mean, people think about it like, oh, okay, hey, I want to really make a largely impactful gift to a small charity, which is great for folks, and they can really change the course of direction for those organizations. Other folks are saying, hey, we're going to give to these multi-billion-dollar charities that where we went to college, some local organizations. So the giving plan, it's mostly a communication, right? Because a lot of folks have now created almost like mission statements around their giving, what they want to accomplish, but think about it more than just a regular cadence of, oh, okay, we're just going to stroke the $10,000 check to our alma mater, right? So, I mean, I think when you think about year-end planning, I mean, we do about 60% of our annual business after Thanksgiving. So the end of the year is when people start to know, okay, how much money can I make? How much can I benefit from deductions? You start doing all of that planning around it and realize, oh, okay, well, hey, tax-wise, I might need to give away this much, but then it's the actual implementation of the philanthropy that comes into play after that.
So what other strategic options are there for supporting one's favorite charities?
So we talk about donor advised funds a lot, but now when you think about lifetime giving, there's also opportunities like private foundations, right? So private foundations, I would say, are a little bit more, I mean, the barrier to entry is a little bit more significant, right? You could start a donor advised fund with a couple $1,000s if you wanted to. Private foundations, there's legal work involved to get its own tax ID and set it up with the IRS. You have an annual filing requirement. I always tell folks that if they're going to set up a private foundation, it's like setting up a charitable business, right? You can pay a staff, you can pay for travel to go on trips to see different charities. You can do fundraising opportunities like golf outings, galas, dinners, and raise money for causes and get other people involved in your philanthropy in a pretty significant way. But here's the thing, private foundations, you really wouldn't start it with anything less than a couple $1,000,000 because of all those costs. Right. So the private foundation has to give out 5% a year to charity. There's IRS requirements, unlike the name suggests, private foundations are anything but private. Right. So if you have anybody that's access to a computer can actually look at the last 5 or 6 years worth of tax returns for any foundation out there, whether that's Bill and Melinda Gates or your neighbor down the street, you can see who they're giving to, the dollar amount in their foundation. So it's interesting, but that's an opportunity for folks to give in maybe a bigger scale to charities and get their family more involved. And they can, like I said, pay a staff. Like a lot of people will have the next generation on the foundation as an employee doing grant research and things like that. So that's more, I would say, it's a little bit more of a wide scale. There's also opportunities out there and this is more of an estate planning, but charitable remainder and charitable lead trusts. So charitable remainder trusts allow donors to get a partial tax deduction up front, but then draw an income stream over the course of their lifetime, usually about 20 years or their lifetime, whatever happens first, where they can actually pull the income from it. And then the charitable giving happens at the end of the trust, where they specify, hey, I want one or these one or multiple charities to be the beneficiaries, principal plus any interest after that term is over, gets distributed to the charity or their donor advised fund. And then the charitable lead trusts, charitable remainder trusts, let's take a step back because high interest rate environment makes it actually better to do it because the tax benefits are better. Charitable lead trusts, we saw those being really popular 2 or 3 years ago when interest rates were very low. It's a great estate planning technique too, especially with the exemption sunsetting in 2025. We don't really know what that's going to look like. It's definitely going to get cut in half at a minimum. So a lot of folks now have their exemption tied up in the value of their house, right? So it's, you think about it from that perspective, and all of a sudden now the estate planning aspect has to come into play. Charitable lead trust is a great way for folks to fund their philanthropy during their lifetime. So they fund the charitable lead trust, the income, the distributions actually go out to the charities, and then the assets that are left over after that generation passes, then get distributed to the next generation outside of the estate. So it's hugely beneficial for folks in terms of planning to say, hey, if I do have charitable inclinations during my lifetime, I can do that, but then earmark these assets to get to the next generation outside of what we have to pay in our taxable interest.
So in talking about the donor advised fund versus a foundation, and I know there's some overlap and there's not a set rule to this, but do you see kind of what's a range from 0 to what, where someone might do a donor advised fund? Whereas I know you said starting around 2 million, people may want to consider a foundation, but what's sort of the range that you might think about for each of these categories?
Back in the day, there was always, if you're going to commit more than $1 million to charity, do the foundation. But it's so much changed over the years because it's mostly about the philanthropic ambitions of the family more than it is about the dollar value. Because the tax benefits in the donor advised fund, which is like a public charity, is actually better than in the foundation. So we now, I think, have 90 donors that have $100 million or more in their account. So it becomes a scenario where, what do you want to do with your philanthropy? Do you really want to operate it like a business and be able to do the travel and everything like that? But a lot of people are just like, hey, we have our charities that we want to give to. We're just going to make those distributions out. I mean, do you need a foundation to do that? Probably not. And not to mention the anonymity of it too, right? So folks are like, all right, well, do I want people to know about who I'm giving to, right? Because a lot of charities use foundation tax returns as a solicitation method, right? Okay, hey, you're giving to an organization like, the Boys and Girls Club. Well, the YMCA will look at that and say, hey, okay, well, we do something similar. Let's solicit those donors, right?
Yeah.
That's something available online for people. So it's, I think it's not mostly dollar value. It's mostly more about what you actually want to do with your philanthropy.
Right. Great. Thank you. And all of these obviously are personal, and they need to be customized to each client and each family. And would like to thank you very much for being here with us and for the education. This has been fantastic. For those of you out there, if you have questions, you can reach us at 888-688-AIRE. That's 888-688-2473. And you can look us up on the web at www.aireadvisors.com. Thank you and have a good day.